Right out of the gate, I mean, just imagine this. Nearly 3 out of 10 people trading in a car owe more on their loan than the vehicle's actually worth.
Yeah, it's wild.
And to fix that math, they are taking out massive 84-month, like 7-year loans just to absorb the old debt and drive off the lot.
Right.
Welcome to Auto News Talk. Buying a vehicle has become this incredibly high-stakes balancing act of stretched budgets, overwhelming technology, and an industry that is basically battling itself behind the scenes.
It really is a profound structural shift. And here is the terrain we're walking through. We're looking at a fundamentally fracturing retail auto landscape.
Yeah.
We're going to trace the exact path from the sticker shock on the lot to the vehicles automakers are forcing onto showrooms to the hidden battles over who actually gets to sell you your next car.
Let's start right with that sticker shock, because the financial gymnastics people are doing to afford a vehicle are terrifying. I mean, taking out a 7-year loan to hide the cost of a depreciating asset feels like taking out a 30-year mortgage on a smartphone. By the time you are halfway through paying it off, the hardware is obsolete.
Yeah, exactly.
The warranty is long gone, and you are still on the hook for the monthly payments. Is this just standard buyer's remorse, or is the system itself breaking down?
Oh, it is heavily systemic. An analysis detailing how dealer leaders are sounding the alarm points out that affordability is basically the absolute center of gravity in the automotive market.
Right.
And it is a compounding issue. You have pandemic-era lease pullbacks.
Which means fewer used cars, right?
Exactly. Fewer affordable off-lease used cars coming back to the market to act as a relief valve. You pair that with significantly higher new transaction prices, and then to compensate, you get those incredibly stretched out loan terms.
And that leads directly to the negative equity trap.
Yeah, that same analysis of dealer leaders shows that over 40% of those negative equity purchases relied on massive 84-month loans.
Wait, 40%?
Yeah, almost half. The implication here is massive. Automakers urgently need to recalibrate their build mixes and pricing to meet buyers at sustainable price points.
Because stretching out a loan to 7 years just to hide the sticker shock is mathematically ruinous for the consumer.
Right, but what that analysis doesn't fully answer is how unresolved friction over inventory and incentives might permanently distract the industry from actually serving customers at these attainable prices.
So if the consumer is drowning in an 84-month loan, surely the dealers are doing something to fix it. Or are they just stuck too?
They are incredibly stuck. A separate report on dealer profitability under pressure confirms this strain is hitting the showrooms hard.
I bet.
Dealership margins are compressing heavily. And what's fascinating is how this financial stress is shifting the relationship between the buyer and the seller post-purchase.
How do you mean?
Well, you are seeing overlapping surveys from both the manufacturers and the dealers, which is turning the post-sale relationship completely adversarial.
Oh, I know exactly what you mean. You buy a car, and suddenly you are bombarded with emails and texts practically begging for a perfect 5-star rating.
Because someone's bonus depends on it.
Yeah, it causes massive customer fatigue.
It really does.
Yeah.
And while margins shrink and dealers scramble for positive survey scores, regulatory guys are widening. That profitability report notes that the Federal Trade Commission sent formal warning letters to exactly 97 dealer groups.
Wow. Over what?
Over advertising practices and undisclosed add-ons.
97 warning letters. That is a very specific, targeted shot across the bow from the FTC.
That is.
That tells you they are actively hunting for bad behavior, like, sneaking in mandatory paint protection plans or nitrogen in the tires, just to pad that shrinking profit margin.
Absolutely. The implication for dealerships is clear. They have to drastically prioritize compliance and negative equity mitigation while fighting for collaborative post-sale relationships.
Instead of adversarial ones.
Right. But the data leaves an open question. What happens to the retail model if these severe affordability pressures persist while used car prices continue to rise?
Because they are rising, right?
Yeah, the reporting specifically mentions a sudden $1,500 jump in used vehicle prices. It squeezes the consumer from both the new and used sides simultaneously.
Which brings us perfectly to the next piece of this puzzle. We have talked about how people are struggling to pay.
Right.
Let's talk about what they're actually paying for. Because the big reason vehicles are so expensive is that they're loaded with features that U.S. buyers simply never asked for.
Yeah, the feature creep.
Again, it goes back to that smartphone analogy. I mean,
Yeah.
Are we paying a premium for giant dashboard screens and complex software suites that we don't even want?
That disconnect is completely at the heart of the problem. A podcast panel review Of mounting dealer pressure zeroes in on this major disconnect.
What did they find?
That automaker policies are creating an existential threat. Vehicles are configured with heavy content that just artificially lifts prices.
But why? I mean, if U.S. consumers are struggling with affordability and taking out 7-year loans, why are manufacturers forcing luxury-level tech into everyday commuter cars?
Because the automotive market is global. Manufacturers are trying to achieve massive economies of scale.
Okay.
That panel review points out that feature-heavy vehicles optimized specifically for international markets, especially China, where large screens are huge selling points, are landing in U.S. showrooms.
So U.S. buyers are getting vehicles meant for another country's tastes.
Exactly. It's expensive content local buyers aren't requesting, but they have to pay for it.
So because a buyer in another market demands a massive digital interface, a commuter here has to take out an 84-month loan to finance a screen they only use to check the radio station.
Basically, yeah. It creates a massive inventory problem for the local dealer. They're stuck with expensive, slow-moving vehicles taking up space.
Right.
The implication is that dealership valuations will heavily reward those operators who execute on affordability and strip away unnecessary inventory costs.
But not every dealership is hurting from this, right? I mean, I imagine selling a high-end tech-heavy vehicle works perfectly well if your customer base has the money for it.
Oh, 100%. That is the dividing line. If you look at a breakdown of dealer pressure points, mainline stores are fracturing under margin thirst.
Mainline meaning like your standard everyday brands?
Exactly. Lowering transaction prices requires totally different trims, which the factories aren't providing fast enough. But premium stores are thriving.
Really? Where?
Premium brand stores in places like Texas, Florida, and Tennessee are completely defying the odds. They are still trading at valuations around or above 10 times earnings.
Wow. 10 times earnings. So if you are selling luxury vehicles in states with high growth, you are absolutely thriving.
Yeah, your buyers want the tech and can afford the price tag.
But if you are selling a standard commuter car, you're getting crushed by affordability and unwanted tech features. The market sounds completely bifurcated.
It is. Rebalanced pricing and a shared responsibility between automakers and dealers is mandatory to lift sales and customer satisfaction.
Right.
But the ultimate unknown here is whether consumer choice will actually reward these rebalanced, stripped-down strategies when they finally hit the lot.
Like, will people actually buy the cheaper car without the big screen?
Exactly. Or have they been conditioned to expect the rolling smartphone even if they can't afford it?
Okay, let's unpack this a bit more. If everyone is broke, the loans are too long, and new gas cars are loaded with expensive tech nobody wants, what is happening with EVs?
That's a great question.
Because I keep hearing EVs are piling up on lots. Who is actually buying them?
A Cox Automotive Market Data Report on EV supply provides a really surprising plot twist here. The EV market is shifting rapidly.
How so?
Well, new EV sales share has slipped year over year, but the used EV market is surging as inventory finally improves.
Wait, surging? I thought buyers were terrified of used EV batteries dying or degrading over time.
The data tells a totally different story. According to the Cox report, new EV supply is tightening down to 75 days, but used EV supply is incredibly lean.
How lean?
31 days. And for Tesla specifically, it is sitting at a 30 days supply.
30 days. That means if they stopped taking in used Teslas, they would be completely sold out in a month.
Exactly. They are flying off the lots.
Why the sudden rush on used EVs?
It comes down to basic math and depreciation. New EV transaction prices are falling, but the used EV market expands choice massively.
Because they're cheaper.
Yeah. The Cox data reveals that the price gap between a new EV and a traditional gas vehicle has narrowed to just $5,800, the lowest on record.
Okay, that's new. What about used?
Here is the memorable detail. The used EV premium is down to a mere $1,012.
Wait, just $1,000? That changes the entire calculus for a buyer.
Right.
If you only have to pay $1,000 more to get a used EV instead of a used gas car, you are going to seriously consider the EV.
Especially if you can charge at home and eliminate your gas bill. The implication is undeniable. The used EV market is the bright spot supporting industry growth as more mass-market models reach resale channels.
It's the affordability solution people have been waiting for. You avoid the massive initial depreciation, you bypass the forced international tech packages, and you get a relatively modern vehicle.
That is the theory. However, what this data doesn't fully answer is whether pricing convergence alone will drive mass adoption.
What else is there?
Structural factors,
Right.
like will charging infrastructure remain the ultimate bottleneck, regardless of how cheap the cars get?
That is a very fair point. A cheap car is practically useless if you live in an apartment and cannot plug it in anywhere.
Exactly.
All right, so we have covered the buyer's struggle, the unwanted technology, and the used EV loophole. Now we have to bring it all together by looking at the turf war over how these vehicles are actually sold to you.
It is a massive turf war.
With all this financial pressure, the OEMs are actively trying to bypass the dealerships entirely. The dealers are fighting back, and the regulators are hovering.
Yeah, it's tense.
Let me ask the obvious question.
Yeah.
Isn't cutting out the middleman supposed to be better for the consumer? Why shouldn't automakers just sell cars directly to us?
It's the source of immense conflict. If we bring back the insights from that podcast panel warning on dealer pressure, they highlight just how intense this direct-to-consumer friction has become.
Right.
Automakers want control, but dealers argue that the franchise system protects the local buyer. The panel cited a very specific example, Volkswagen's planned Scout brand.
The Scout brand. Why is that a flashpoint?
Because it is acting as a massive flashpoint for bypassing established franchise territories. Dealers have invested millions in physical facilities based on franchise agreements.
So when an automaker tries to launch a parallel brand directly to consumers, dealers view it as an existential threat.
Precisely. Furthermore, the panel noted that Tesla's roughly 5% market share is effectively testing the limits of the direct model's scalability.
Meaning it's relatively easy to sell direct when you are a niche player, but harder at scale.
Yeah, when you need to process hundreds of thousands of trade-ins and handle massive service recalls, you actually need that middleman infrastructure.
I see.
But the automakers still try to heavily control the dealers they do have. If we look back at the profitability report we discussed earlier, it outlines a major control tactic stair-step incentives.
Oh, I have heard of stair-step incentives. This is where the math gets incredibly chaotic for the consumer, right? Walk me through how this actually works.
Essentially, an automaker tells a dealer, if you sell 99 cars, you get a small bonus. But if you sell exactly 100 cars, you unlock a massive retroactive bonus for all 100 cars you sold.
So the dealer becomes completely desperate to hit that magic number.
Desperate enough to do incredibly irrational things. A salesperson might take a massive loss on that 100th car just to trigger the factory payout.
It creates unpredictable pricing for the consumer. One person buys a car and pays full price. Someone else walks in when the dealer is one car short and gets an unbelievable deal.
It turns buying a car into a casino game, and dealers hate it just as much as consumers do.
Really?
Yeah, the profitability report cites a staggering statistic. A full 97% of dealers view stair-step programs unfavorably.
Wait, 97%? And earlier you said 97 FTC warning letters. What a weird coincidence.
I know, right? Just a statistical quirk in the reports. But yeah, 97% of dealers hate these programs.
That's practically all of them.
It breeds total distrust. It is worth noting that the most stable, profitable brands avoid them entirely. Toyota is specifically called out in the report for avoiding stair-step programs.
They just focus on disciplined inventory management instead of arbitrary gamification.
Exactly.
So if we step back and look at this entire massive machine, what is the actual takeaway? How does this all fit together?
Well, three overarching themes emerge across all the data we have looked at. First, affordability is the gravity dictating absolutely everything else.
Right. That was clear from both the dealer leaders report and the profitability report.
Exactly. Consumers are maxed out, relying on dangerous 84-month loans. Second, there's a glaring disconnect between manufacturer vision and local buyer reality.
The feature creep.
Yeah, supported by the podcast panel and the Cox EV data. Automakers are pushing tech-heavy standards onto U.S. buyers who didn't ask for them. But when you offer an affordable alternative, like a used EV, they buy it.
And the third theme?
The regulatory and structural reshaping of how cars are sold. From the FTC sending warning letters in the profitability report to the sheer panic over direct-to-consumer models in the pressure points breakdown.
And within those themes, there are some really sharp contradictions, right?
Yeah. Two major tensions are defining the market. The first is the valuation split.
Okay.
If you look at the pressure points breakdown versus the dealer leaders analysis, premium stores in states like Florida and Texas are booming at 10x multiples.
While mainline stores are literally fracturing under margin stress.
Exactly. The second tension is direct sales versus franchises. Automakers are pushing for direct-to-consumer control, which the podcast panel highlighted.
While dealers, backed by the profitability reports, warn this strips away local consumer protection.
You've got it.
So boil this all down for the person listening to Auto News Talk who just needs to replace their old sedan. what is the practical takeaway here?
The practical takeaway is all about navigating the friction. If you are shopping for a vehicle, the absolute best value intersection lies in two places.
Which are?
First, the used EV market, where the premium over gas cars has almost vanished. Second, disciplined brands like Toyota that strictly manage their inventory to avoid negative equity traps.
That makes perfect sense. Find the brands that aren't playing casino games with their own dealers, or look for the vehicles where someone else has already paid the massive depreciation penalty.
Exactly. But I want to leave you with a final thought to mull over as the industry continues to evolve.
Oh, lay it on A.
We have talked a lot about the physical cars and the physical lots, but as vehicles increasingly become essentially software subscriptions on wheels, will the dealership of the future even be a place where you go to buy a car?
Oh, wow.
Or will it merely become an IT service center mandated by the manufacturer just to fix your mandatory tech?
From haggling over horsepower to waiting in line to the Genius Bar for your transmission to update, that is a completely different world.
It really is.
Well, thank you for joining us for this segment of Auto News Talk. It has a lot to process, but understanding these hidden gears of the industry is the only way to protect your wallet.
Absolutely.
Keep an eye on those used EV lots and ask yourself, how much of that giant dashboard screen are you really willing to finance for the next 84 months? We will see you next time.
Of their repair needs spikes the repair order revenue.
Absolutely.
And on the flip side, the Auto News Talk piece on TILA compliance proved that you need absolute rigorous transparency and accuracy in your finance math, or state regulators will shut you down.
I would add a third theme to that structure. The customer experience ultimately dictates the success of any technology. Digital retailing saving a customer 45 minutes in the showroom is a massive win. But forcing a driver to navigate a complex touchscreen just to roll down a window, as we saw with the original VW ID4, is a massive failure.
But navigating all of this is incredibly difficult for the industry because there are massive competing interests at play. You have this intense contradiction between the push for high-speed digital automation, which we saw heavily promoted in the AI sales article, versus the absolute need for slow, meticulous human accuracy, like we saw with the AI finance compliance piece.
Yeah.
The move fast and break things philosophy of Silicon Valley just does not work when you're dealing with state usury laws.
It absolutely does not. And the second major contradiction is between the automakers, who desperately want to pack their cars with futuristic, screen-heavy technology to appear cutting edge, versus the actual consumers who are practically begging for the return of simple, traditional controls.
So if you're running a dealership or designing a car, what is the ultimate takeaway here?
The practical mandate is that the industry must stop implementing technology just for the sake of looking modern. Every single tool, whether it's a 23,000 square foot offsite inspection center, a gig economy app for delivering an alternator, or a physical tactile window switch, must explicitly solve a friction point for the user. If the technology creates friction rather than removing it, it has to go.
That is the perfect place to land as we wrap up this segment of Auto News Talk. It really puts the evolution of the whole industry into perspective. Whether it's a hyper-advanced AI chatbot calculating the parameters of your auto loan in the cloud, or just the satisfying physical click of a window switch under your finger, the absolute best innovation is simply the one that actually works when you need it to.
Function over flash, every single time.
Next time you take your car in for a service appointment or start shopping for a new vehicle online, keep an eye on how your local dealership balances the digital screen with actual human service. That balance is the future of the industry. Thanks for joining us on Auto News Talk.